Most traders see noise. You're about to see what the institutions see. Before anything else, here is the promise. This is a real Apple chart, and if it still looks like noise to you, that is exactly why this course exists. By the end, you will read this like an institution. You will spot the shelf where buyers kept defending, the zone where big money loaded up. You will catch the day that ceiling finally snapped, the moment structure broke in the buyer's favor. You will see the staircase the trend builds on the way up. A rising low, then another, then a third, and you will respect the warning wick where buyers charged to a record high and sellers slammed it all back. After that warning, this slide surprised nobody who could read it. 12 skills, structure, zones, indicators, confluence. 3 traders, 1 language. By the final chapter, you will write a complete trade plan on a chart exactly like this one. Here is the whole journey on one map in 3 stages. Stage 1. You learn to read the market like an institution. It starts with how structure breaks, the difference between a trend continuing and a trend reversing. Then the order block, where the big money actually bought. Then fair value gaps, the imbalance price comes back to fill. And then support and resistance, where a broken ceiling becomes a floor. Stage 2, the indicator toolkit done right. Moving averages as dynamic support. The relative strength index and the divergence it hides, the MACD and its zero-line rule, anchored VWAP, the institutional cost line, and Fibonacci, the golden pocket. Stage 3, execution and edge, relative strength, so you buy the leaders, the pullback versus the retest, and one trading plan that stacks every skill into a single A+ trade. 3 traders are about to walk this exact road with real money. Let's meet them. These 3 leveled up, bigger accounts, harder setups. Each starts this course with $25,000. This is Mike. He reads structure before he ever looks at an indicator, and he only pulls the trigger when the whole chart agrees. This is Jake. Rules are for other people. He chases every breakout and every indicator cross. He doubles down when he is wrong, and he still has never set a stop. And this is Tom. He knows every setup and trusts none of them until it is too late. He is always late. Same charts, same money. Keep your eye on the gap that opens between these 3 curves. Chapter 1. Market structure, the skill everything else in this course stands on. Here is the whole idea on one real chart. This is Nvidia climbing in a clear uptrend. Now watch the prior swing high near 217. Price closes above it. That is a break of structure. The trend just told you it is continuing, so you ride it, and it runs to 237. But every uptrend has a floor, the last higher low, here near 209. As long as that floor holds, the trend stays alive. Then price closes below it. It just made a lower low. That is a change of character. The same trend that was pulling price up has flipped. Break of structure says go. Change of character says stop. Let's learn the routine. Here is the routine that turns a messy chart into a clear story. Price is telling you 4 steps and you will never be lost in a trend again. Let us build it on a clean diagram first. Step 1. Map the swings. A trend is nothing but swing highs and swing lows. In an uptrend, they step upward. Each high is a higher high. Each low is a higher low. That staircase is the structure, and it is all you need to mark. Step 2. The break of structure. As long as the trend is healthy, price keeps closing above the last swing high. Each time it closes above that high, that is a break of structure. The trend confirming itself. It is your green light to keep trading with the trend, not against it. Step 3. The change of character. Every uptrend has a floor, the last higher low. The trend is alive as long as that floor holds. But the day price closes below that higher low, it has just made a lower low. That is a change of character. The trend's character has flipped from up to down. This one signal is your earliest warning that the run is over. Step 4. Trade the structure. After a break of structure, you buy the pullback back toward the broken level, put your stop just below the higher low, and target the next high. And after a change of character, you do the opposite. You exit your longs, and you can flip short, selling the lower high, stop above it, targeting the next low. Map the swings, respect the break of structure, fear the change of character, and trade with the structure. Now let us run that exact routine on a real chart and watch 3 very different traders take it. Now a real chart, and the whole reason the change of character matters. This is Netflix, and it is where reading structure saves your account. Netflix had been a clean uptrend, topping out at the peak near 109. Jake, of course, buys that high. The breakout, no stop, certain it keeps going. Now watch the floor. The last higher low of that uptrend sits at 90. The rule from step 3 is simple. The uptrend is alive only while 90 holds. Then it happens. Price closes below 90. That is a change of character. The trend that was making higher lows just made a lower low. The character has flipped from up to down. To Jake, that drop is just another dip to buy, so he buys it again near 88. No stop. Sure, it will bounce like every other dip, But after a change of character, the bounces are lower highs. Netflix bounces to a lower high near 91 and rolls over. Mike sees the change of character, so he does the opposite of Jake. He flips short, selling that lower high near 89. His stop goes just above the lower high at 92, and his target is the next low at 83. Tom chases the dead bounce long, but at least he keeps a tight stop, so the flip costs him only a small loss. And Netflix breaks down exactly as the structure warned. Mike covers at the target near 83, his biggest winner of the chapter, taken on the short side because he read the flip. Jake, still holding with no stop, rides every single dollar down past 85, 83, 81. The dips he kept buying were never pullbacks. The trend had already changed character. One reversal and the structure handed him a brutal lesson. That is the difference between a break of structure and a change of character. Chapter 2. Order blocks, where the big money actually bought. Here is the whole idea on one real chart. This is Google in January. See this? One ordinary red candle in a quiet pullback. Then an impulsive leg smashes through the prior swing high. A move that strong is not retail. That is institutional buying, and they could not fill it all at once. That last red candle before the leg is the order block, the zone where their orders sit. So you draw the zone and you wait. Price drifts back, touches the zone once, and launches straight back up to the target. The top of that leg. You didn't chase the breakout. You bought where the buyers already were. Let me show you the exact routine. Here is the routine 4 steps, and the fourth one is the difference between a real edge and a donation. Clean diagram first. Step 1. Find the impulse. You are hunting for one specific move, a leg so strong it closes above the prior swing high. That kind of displacement is not retail clicking buy. That is an institution filling a position too big to hide. Step 2. Mark the order block. Before every impulse there is a footprint, the last red candle right before the leg took off. Institutions were filling buys into that selling, so you mark that candle's range from its low up to its open. That band is the order block. Step 3. Wait for the first return. You do not chase the impulse. Big orders never fill in one pass, so price gets pulled back to the zone to fill the rest. That first touch, traders call it mitigation, is your moment, and only the first touch. Step 4. Trade it, and measure the break first. Entry at the zone top on that first return. Stop goes about 1% below the zone low. Target the high of the impulse, but measure how far the impulse broke the prior high first. A break by a fraction of a percent is a weak footprint, and weak footprints fail, so you skip those zones. Find the impulse, mark the last red candle, wait for the first return, and measure before you trade. Now let's run it on a real chart with 3 very different traders. Now a real chart, step by step. This is the AMD chart from this spring. First, the structure. AMD had stalled twice at the same ceiling. A double top, so that is the prior swing high everyone is watching. Below it, the pullback grinds lower, and right at the bottom of that pullback sits one last red candle. On a day when the selling looked endless, then the impulse. Price explodes through the double top in one giant green day. Somebody absorbed all of that selling, and then bought so hard the ceiling broke. That buyer left a footprint. So Mike marks the zone, mark that candle, from its low to its open. Jake buys that giant candle instead, at the very top, oversized, no stop. Now the wait, a move that big never fills in one pass. Price drifts back day after day and slides into the zone, the first return. Mike's order is already sitting there, and it fills at the zone top. His stop sits 1% below the zone low, and his target is the impulse high. 2 days later comes the test. The wick stabs deep into the zone and holds above the zone low, by 60 cents. That is institutions defending their own orders. Jake can't take it. He dumps everything in a panic at the bottom of that wick, selling at almost the exact price where Mike bought. From there the zone does its job. Price lifts off, and when a big green confirmation candle prints, Tom finally believes, and buys at full price right under the old top. And then AMD tags the impulse high. The zone paid Mike 3-1, Tom got a tiny scrap for the same idea, and Jake paid the most and lost the most on a chart that went exactly where he thought it would. Chapter 3. Fair value gaps. The imbalance price comes back to fill. Here is the whole idea on one real chart. This is Tesla. Last summer, price is sliding, and then one explosive green candle changes everything. A candle that fast has a problem. Nobody got to trade the prices inside it. Look at the 3 candles. The first one's high, the third one's low. The void between them is the fair value gap. The price is the market skipped. The run breaks the July ceiling, and you do not chase it. You wait, because price almost always comes back. 12 days later it drifts back, touches the band once, and launches straight back up to the target, the top of the run. You didn't buy the breakout. You bought the prices the market owed you. Here is the exact routine. Here is the routine 4 steps, and the fourth one is what separates a real edge from a donation. Clean diagram first. Step 1. Find the displacement. You are hunting one specific candle, a candle so big and so fast it dwarfs everything around it. That is the market repricing. An institution moved the price faster than orders could keep up, and a move that fast leaves something behind prices that never traded. Step 2. Mark the gap. Look at 3 candles, the one before the big move, the big candle itself, and the one after. Take the first candle's high and the third candle's low. If there is a void between them, a band the wicks never covered, that is the fair value gap, an imbalance. Every order that wanted those prices is still waiting there. Step 3. Wait for the first return. Markets hate unfinished business. Price gets pulled back to the void to fill those resting orders. The first touch is your moment, and here is the part most people miss: gaps do not expire. A gap can sit for weeks and still get respected to the dollar. Step 4. Check the trend behind the gap, then trade it. A gap from a move breaking out upward gets the full plan entry in the gap. Stop 1% below the gap bottom. Target the high of the impulse. But a gap from a quick bounce inside a falling market. A bounce that dies on a lower high. That gap is a floor made of paper, so you skip it. And one rule that never bends: the moment a candle closes through a gap, that gap is dead. Find the displacement. Mark the void, wait for the fill, and check the trend before you trust it. Now let's run it on a real chart with 3 very different traders. Now a real chart, step by step. This is the Palantir chart from this spring. First, the structure. Through late February, the rally stalls at the same ceiling twice, just under 148. Then the displacement. One giant green candle rips through it and closes miles above. That is the market repricing, and it moved too fast. The candle before it and the candle after it never touch each other. Mike marks the void: first high to third low, 147.50 up to 149.61. His entry order goes to the gap top, his stop 1% below the gap bottom, his target the high of the impulse. Jake doesn't mark anything. The big day convinces him the rocket is leaving, so he buys the top of it. Oversized, no stop at 160. Now watch how precise this gets. 4 days later, price pulls back and misses the band by 50 cents. That is not the fill. Mike doesn't move. The next day, price dips into the void, and his resting order fills at the gap top while everyone else is panicking about a pullback. And Jake, 2 days after the fill, the same pullback that handed Mike his entry scares Jake out. He dumps the whole thing at 149, almost exactly where Mike's order filled. Same price. One of them planned to buy it, the other was forced to sell it. That is the entire difference between trading the void and chasing the candle. A week later, price stabs at the band one more time and the market defends it again. The resting orders are still there. Then the turn, a 20-point week, and the last big green candle finally convinces Tom, who buys at 160, full price for a void Mike bought at 149. The next day, Palantir tags 162.40, target. The void pays him 3-1. Tom gets a tiny scrap for the same idea, and Jake paid the most to lose the most on a chart that went exactly where he said it would. Chapter 4. Support and Resistance. Floors and ceilings, the handful of prices where the market keeps changing its mind. This is Amazon last fall. Watch the same ceiling work over and over. Early September, the sellers held the line. Days later, then again, and one more time after that. The shelf is real. Then earnings hit and price blasts through that shelf without even pausing. Now watch the part that matters. A week later, price falls all the way back to the exact shelf that rejected it 3 times, and the shelf catches it like a floor. The ceiling changed jobs. That is the roll flip, and it is the most useful habit a level has. One more thing, and it should give you chills. That chart is from last fall. This very week, months later, Amazon is trading right back at that same shelf. Good levels do not expire. Let me give you the rules. 4 rules turn random lines into real levels. First, the turning points. A level is not a magic number. It is simply a price where the market turned before. Find the spot where price reversed hard, draw a horizontal line through it, and you have a candidate. Second, the touches. 1 turn could be an accident. 2 is interesting. When price comes back yet again and the same line holds, that level is real, and it grows stronger with every extra touch that never closes beyond it. Third, the flip. When a real ceiling finally breaks, it does not vanish, it changes jobs. Old ceilings become new floors, old floors become new ceilings. The retest of a freshly flipped level is one of the cleanest setups in all of trading. Fourth, the edges. The money sits at the edges of the range. You buy at the floor with your stop just beneath it, and you take profit into the ceiling. The middle of the range is no man's land. No level near you, no edge, no trade. Turning points, touches, the flip, the edges. 3 traders, 1 range, watch who respects the middle. Now the range with money on it. This is ServiceNow last fall. And unlike the staircase from last chapter, this market is going nowhere. Price is locked in a box, and a box has exactly 2 places worth your attention. The ceiling overhead. Every rally into the mid-190s gets sold, and down below the floor zone, a floor that began life as an August ceiling, the exact roll flip you just met. Watch it work. Early September, price drops into the zone and holds it. A month later, back again, holds again. The level is real, the box is real. Mid-October, a big green day pops in the middle of the box, far from both levels. And that is all Jake needs. He buys the middle, no level above him, no level beneath him, just motion. For 2 days nothing happens because mid-range air has no opinion. Then price slides back toward the floor, and Jake's nerve slides with it. At the bottom of the slide he panic sells, straight into the floor zone. And here is the lesson the market hands out for free. Jake sells at the very same price on the very same day where Mike's resting order buys. One price, two traders, opposite directions. And the only difference is that Mike knew the level was there. The floor holds for the third time in 2 months, and Mike is in. His stop sits beneath the floor zone. If the floor truly fails, he is out for pennies. His target sits just under the ceiling, because edges are where profits get taken. 3 green days later the bounce is obvious, and that, at last, is enough for Tom. He pays $188 for what Mike bought at $179, then sits through a red week with no room to breathe. Then earnings night arrives and resolves the range. Price surges into the ceiling, tags the target, and Mike collects almost 3 times what he risked. His stop never once threatened. Tom's reward for all that waiting about $50, and Jake donated $245 to learn that the middle of a box pays nobody. Floors, ceilings, and the no man's land between them. That is the whole geography. Next up, floors that slope, trend lines and channels, the diagonal floors of a trending market. That is Act 1 done. You can now read structure like an institution, and the gap is already real. Mike read the change of character, the order block, the gap, and the clocks agreeing. 4 disciplined reads, and he is up about $2,000. Tom scraped a little each time, the way the late trader always does, and Jake has burned more than $5,000 fighting the same structure 4 times in a row. Now Act 2. The indicators that confirm what structure already told you. Chapter 5, Moving Averages. Everything so far you had to see for yourself. This tool sees it for you. This is NVIDIA last summer. That smooth line under price is a moving average. The average of the last 50 closes, redrawn every day. Nothing more. But watch what it does. Mid-September, the dip lands on that rising line, and then price rides it for days, kissing it again and again, once to the penny, before the bounce that follows carries it back toward the highs. The staircase from Chapter 1, drawn for you. Moving support, and the slow dashed line far beneath everything, the 200-day, the tide itself. Above a rising 200, dips are for buying, below a falling one, bounces are for selling. That single sentence retires half of all beginner mistakes, including the one Jake is about to make. The speeds, then the money. 3 speeds, 1 tide. First, what the line is. Take the last 50 closes, average them, plot the dot, and each new day, drop the oldest close, add the newest, and re-average. That is the whole machine. The line is smooth because it forgets slowly. Second, the speeds. The 20-day is the sprint. It hugs price and turns fast. The 50-day is the swing, the rhythm of the move. And the 200-day is the tide. Slow, heavy, and the single most watched line in all of markets. Same math, 3 different memories. Third, moving support. In a healthy trend, pullbacks kiss the rising average and bounce. A floor that climbs with the trend, the staircase automated. The kiss of a rising 50 is one of the most reliable dip buys in trading. Fourth, the tide rule. Above a rising 200, dips are for buying, and shorting is fighting the tide with your account as the paddle. Below a falling 200, bounces are for selling and knives are for not catching. Pick the side of the tide every time. The machine, the speeds, the kiss, the tide. Now watch the tide rule pay one trader and fine another. Now the averages with money on them. This is Microsoft last fall, climbing along its rising 50 all season, with the 200-day far beneath it, rising too. The tide is up, and it has been up all fall. In mid-October comes exactly the dip the playbook describes. Price pierces the rising 50 by less than 1% for a single session, and 2 days later it closes back above the line. That reclaim is Mike's entire signal, the kiss of the 50 in a rising tide. He buys the close, puts his stop just under the average. If a rising floor this strong truly fails, the pullback is something bigger, and targets the prior high overhead. 3 green sessions later the bounce is undeniable, and that, as always, is finally enough for Tom. But the same week Jake smells excess. Microsoft is 13% above its 200-day, and to Jake that reads as gravity owed. So he shorts it, above a rising 200, against everything the tide rule just said, with no stop. He is not shorting Microsoft, he is fighting the tide with his account as the paddle. The days that follow settle both trades. Price glides up the 50 and tags the prior high. The kiss pays Mike 2.3 times his risk textbook, and the morning after, earnings gap the stock $24 higher. Jake surrenders into the gap at the open, $700, paid to the tide he refused to respect. The tide sent the bill overnight, by the kiss of a rising average, never short above a rising 200. The lines are not magic. They are the crowd's memory, and the crowd defends its memory. Next, the relative strength index, the oscillator everyone misreads, and the divergence it hides. Chapter 6, the relative strength index. Now the indicators begin, and this is the one every beginner misreads. Here is the whole edge on one real chart NVIDIA this spring. In late April the RSI hit 76, deep into overbought. The textbook screams sell, but in a strong trend, overbought is a sign of strength, not a sell signal. Price barely pauses. Then the trend takes a breather and pulls back. Watch the RSI, it does not crash to 30. It taps the midline, the 50 line, and turns up. That is the reset to 50. The dip worth buying. Mike buys with the trend and price runs to new highs. The 50 line is your trend filter. Let us learn the routine. Here is the routine for reading the relative strength index in 4 steps so it never fools you again. Step 1. What RSI is. It is a momentum meter that rides along underneath the price, scored from 0 to 100. It climbs high when buyers are pushing, and it falls low when sellers are. That is all it measures how strong and how one-sided the recent move has been. Step 2. The beginner trap. The textbook says sell above 70 and buy below 30, but in a real trend, the RSI pins above 70 and just stays there for weeks. Selling every overbought print is how beginners get run over, again and again. Overbought is a sign of strength. Step 3. The 50 line. Forget 30 and 70 for a moment and look at the line in the middle. While RSI holds above 50, momentum belongs to the buyers and you hunt only for buys. Below 50, the opposite. The 50 line is your trend filter. Step 4. Buy the dip to 50. In an uptrend, the pullback worth buying does not crash to 30. It resets to about 50, taps the midline, and turns up. You buy that reset with the trend, put your stop under the dip low, and target the next leg, the meter, the trap, the 50 line, the reset. Now watch it pay one trader and punish another on a real chart. Now the RSI with money on it. On NVIDIA, the same chart run by 2 traders. In late April, the RSI hits 76. Jake reads one number overbought, it must fall. So he shorts it oversized, no stop, fighting a strong uptrend with a textbook rule. Mike does nothing yet. He knows overbought is strength, so he waits. In early May the trend finally pulls back, and the RSI does not crash. It taps the midline 50 and turns up. That is the dip we waited for. Mike buys the reset close around 200, puts his stop under the dip low at 194, and targets 212, a clean 2-to-1. Now the 2 trades settle. Price curls up off 50 and Jake is run over. The strength he shorted just keeps climbing, and he covers in the red, $650 gone, no stop to save him. A big green day is finally enough for Tom, late as ever, and a couple of days later price tags 212. The reset pays Mike 2-to-1, bought the dip with the trend, not against it. Overbought is not a sell signal. The 50 line is next, the MACD and its 0 line rule. Chapter 7, the MACD. It gives a buy and sell signal every few days, and trading all of them will bleed your account dry. Here is the one filter that fixes it, the 0 line. This is AMD this spring. The MACD crosses above the 0 line, and that is the cross that counts, because above 0 is the bull's territory. Mike takes it. The trend confirms and the stock explodes for a clean 2-to-1. Crosses that happen below 0 in chop are fake outs. Only the cross above 0 is the real signal. Let us learn the routine. Here is the routine for the MACD in 4 steps so it stops whipsawing you. Step 1. What it is. Take 2 moving averages and subtract them, that is the MACD line. A slower average of that line is the signal line and the bars underneath, the histogram. Just measure the gap between the 2 3 pieces, one momentum tool. Step 2. Every cross is noise. The rookie trades each time the MACD line crosses the signal line. But in a choppy market those 2 lines cross back and forth constantly, and trading all of them is death by 1,000 cuts. Step 3. The 0 line filter. This is the whole edge. When the MACD is above the 0 line, momentum is bullish, and you take only buy crosses. When it is below 0, momentum is bearish, and you take only sell crosses. The 0 line tells you which crosses to ignore. Step 4. Take it and manage it. On a buy cross above 0, you buy, put your stop under the recent swing low, and target the next leg, and you exit when the MACD crosses back below its signal, the momentum handing back. The 3 pieces, the noise, the 0 line, the trade. Now watch it pay the disciplined trader and bleed the one who trades every cross. Now the MACD with money on it. On a MD this spring. Early in the window the stock is just chopping sideways and the 2 MACD lines cross back and forth below 0. Jake trades every one of them. He buys the first cross, gets whipsawed, buys again, whipsawed again, death by 1,000 cuts, all of it below the zero line where nothing was confirmed. Mike ignores all of it because none of those crosses happened above zero. Then, in early April, the MACD finally crosses above the zero line, the cross that counts. Mike takes it, stop under the swing low at 196, target the next leg at 262. Now it settles. The chop finally bleeds Jake out and he gives up. $700 gone on signals that never mattered. A big trend day is enough for Tom late, and the trend explodes. A MEMD runs straight to 262 and pays Mike 2-1 in full. One cross mattered, and it was the one above zero. Next, anchored VWAP, the line institutions defend. Chapter 8, Anchored VWAP. This is the line the institutions actually defend because it is their average cost. VWAP is the volume-weighted average price, anchored at a major swing low, and it rises as a line of dynamic support. This is Apple this spring. Price drifts down, wicks below the rising VWAP and reclaims it on the close. The big money is defending their cost. Mike buys that reclaim, the line holds, price pulls away, and the trade pays nearly 3-1. By the touch of a rising anchored VWAP, let us learn the routine. Here is the routine for anchored VWAP in 4 steps. Step 1, what it is. VWAP is the volume-weighted average price, the true average price every single share traded at, weighted by how much volume traded there. It is not a guess. It is where the big money's cost actually sits. Step 2, anchor it. Instead of resetting each day, you anchor the line to a major event, a swing low, an earnings gap, the start of a move. From that anchor forward, the line tracks the average cost of everyone who bought the move. Step 3, dynamic support. In an uptrend, the anchored line rises underneath price and pullbacks to it tend to bounce because the institutions who are in profit step back in to buy at their own average cost. The line becomes dynamic support that climbs with the trend. Step 4, buy the touch. When price pulls back to the rising line and reclaims it on the close, you buy that reclaim, put your stop just below the line, and target the next leg. And the day price closes and stays below it, the trend is hurt, you stand aside. The cost line, the anchor, the support, the touch. Now watch the line pay one trader and punish the one who fought it. Now anchored VWAP with money on it. On Apple this spring, the line is anchored at the late March swing low and it rises as dynamic support all through April. In early April, price drifts down and one bar wicks below the rising line, then reclaims it, closing back above. That is the touch the institutions defending their average cost. Mike buys the reclaim, stop just below the wick, target the breakout shelf near 280. Weeks later, Jake looks at the same chart and decides it is simply too high. He shorts it, straight into the rising VWAP against institutional cost, no stop. The line carries price right over him, and he covers in the red, $600 gone. A late green push is finally enough for Tom, and then price tags 280, the shelf. The line held the whole way, and Mike is paid nearly 3-1. By the touch of a rising anchored VWAP, never short into it. Next, Fibonacci and the golden pocket. Chapter 9, Fibonacci, and the only zone that matters, the golden pocket. This is where professional dip buyers wait. This is Tesla this spring. Draw the tool from the swing low to the swing high, and the pocket appears between the 0.618 and 0.65 retracements. The sweet spot a healthy pullback stops at. Price dips, the wick tags the pocket, and rejects. Mike buys that rejection. Price reverses and runs to the extension above, paying 3-1. Don't chase the top, buy the golden pocket. Let us learn the routine. Here's the routine for the golden pocket in 4 steps. Step 1, draw the tool. Pick one clean impulse leg and anchor the Fibonacci tool from its swing low to its swing high. The tool splits that move into retracement levels. The percentages a pullback might give back. Step 2, the golden pocket. Ignore most of those lines and look at the 0.618 and the 0.65. The zone between them is the golden pocket, a deep but healthy retracement, the level where strong trends most often resume. Step 3, wait for the tag. Do not pre-place a buy in the pocket and hope. Wait for price to actually dip into it and print a rejection, a wick that pierces the pocket and closes back out. That rejection is the buyer stepping in to defend the move. Step 4, entry, stop, extension. You buy that rejection. Your stop sits below the 0.786 line because a retrace that deep means the move has failed, and your target is not a guess. It is the Fibonacci extension above the 1.272 and the 1.618. Draw it, find the pocket, wait for the tag, then trade the extension. Now watch the pocket pay one trader 3-1 and bury the one who caught the knife. Now the golden pocket with money on it. On Tesla this spring, price rallies to a swing high near 409, then rolls over. Jake sees a falling stock and buys early because it looks cheap, no tool drawn, no pocket, no stop. He is catching a falling knife. Mike draws the tool from the swing low to the swing high and marks the golden pocket between 364 and 373. Then he waits. Price dips, the wick tags the pocket and rejects, closing back out. That is the signal. Mike buys the rejection at 376, stop below the 0.786 at 351, target the extension at 429. That same low, the bottom of the rejection wick, is where Jake finally panics and sells, $650 gone, selling the exact spot Mike bought. A late green run is enough for Tom, and price reverses hard, climbing all the way to the extension at 429. The pocket pays Mike 3-1. Buy the pocket, never the knife. That closes Act 2. Let us check the scoreboard. Scoreboard, end of Act 2. Mike has now turned every indicator into a disciplined win, 9 in a row, his account near $31,000. Tom keeps scraping crumbs, and Jake fought every single signal, shorting strength, trading every cross, fighting the line, catching the knife, and is down to about 16,000. Act 3 is the edgy which stock to even trade, and how to execute it perfectly. Chapter 10, Relative Strength. Before you pick a setup, pick the right stock. Money rotates into the strongest names, and they fall the least and recover the first. Here is a leader. When the broad market wobbles and makes a lower low, this name refuses to follow. It holds a higher low, its shelf. Lay the stock over the market and that gap, the stock above the index, is relative strength. You buy that leader as the market turns, and it breaks away to new highs while the index only crawls. Buy the leader, skip the cheap laggard. Let us learn the routine. Here is the routine for relative strength in 4 steps. Step 1, rank the field. The market is not one thing. Money rotates into the strongest sectors, and inside those sectors into the strongest names. Your job is to trade those leaders, never the average of everything. Step 2, measure strength. Lay your stock right on top of the index and ask one question: is it stronger? The cleanest tell is a higher low while the market makes a lower low. The leader refuses to follow the market down, it sits above the market line. Step 3, buy as the market turns. You do not catch the falling market. You wait for the index to stop falling and turn back up. The instant it does, the leader breaks out first and hardest, because that is the name everyone wants to own. Step 4, manage and rotate. Your stop goes under the leader's higher low. Your target is the next measured leg, and here is the part most people miss. The day your leader starts lagging the market, you rotate out, because leadership is rented, not owned. Rank, measure, buy the turn, then rotate. Now watch the leader pay, and the cheap laggard punish the buyer who could not resist a bargain. Now relative strength with money on it. This is Micron this spring, a clear leader, printing higher high after higher high. Jake looks at it and balks. It has already run, it is expensive. So he goes hunting for a bargain instead and buys a cheap laggard that has been lagging the market for weeks, certain it is due to catch up, no stop. Mike does the opposite. He stays with the leader and waits. When the broad market wobbles, Micron refuses to follow. It holds its shelf around 650, a higher low while weaker names break down. That is relative strength. Mike buys the reclaim at 700, stop below the shelf at 635, target the next leg at 915, and Jake's bargain, weak stayed weak. It sinks while the leader climbs, and he finally cuts it, $500 gone. The bargain that never caught up. A late green push is enough for Tom, and Micron breaks away to 915, leaving the market far behind, paying Mike 3-1. Buy strength, not bargains. Next, the difference between a pullback worth buying and a knife worth dodging. Chapter 11. The pullback versus the retest. The difference between buying a dip and catching a knife, and between chasing a breakout and timing it perfectly. This is Texas Instruments this spring. Price closes above a ceiling it tested for weeks. The rookie chases that breakout candle. The pro waits. Price comes back down and retests the old ceiling, and it holds, because a broken ceiling becomes a new floor. That retest is the entry, a clean hold, tiny risk, and price runs 3-1 to the measured move. Don't chase, buy the retest. Let us learn the routine. Here's the routine for the pullback and the retest in 4 steps. Step 1, pullback or knife. These look identical for one day and end completely differently. A pullback is a dip inside an uptrend that lands on support and holds. A knife is a downtrend, where each level the rookie calls support just keeps breaking. The trend decides which one you are looking at. Step 2, the breakout retest. When price breaks above a ceiling it has been stuck under, do not chase the breakout candle. The magic is what happens next. That broken ceiling flips and becomes a floor. So you wait for price to come back and test it. Step 3, wait for the hold. The retest has to actually hold. Price taps the old level and closes back up off it. That is buyers defending their new floor. If price closes back below the level instead, the breakout has failed and you stand aside. Step 4, entry, stop, target. You buy the hold. Your stop goes just under the level. If it fails from there, you are wrong but cheaply. And your target is the measured move, the height of the prior range projected up from the breakout. Trend first, then the retest, then the hold, then the bracket. Now watch the retest pay the patient trader and the chase punish the impatient one. Now the retest with money on it. On Texas Instruments this spring, price closes hard above a ceiling it tested for weeks. Jake chases it instantly, buying the very high of the breakout candle, oversized, no stop. Right idea, worst possible entry. Mike waits. 2 days later, price does what breakouts do, it comes right back down and retests the old ceiling, and it holds, closing back up off the lid. The old ceiling is now a floor. Mike buys that retest at 288. Stop just under the level at 283.50. Target the measured move at 360. But that very same normal retest dip shakes Jake out. He bought the top, so the pullback puts him underwater, and he panics out for $450 right where Mike is buying. A late green run is enough for Tom, and price launches to 360, the measured move, paying Mike 3-1. Same breakout, same chart. One chased it and lost. One time the retest and won. That ends Act 3's setups. Let us check the scoreboard, then stack everything into one plan. The scoreboard with one trade left. Mike has stacked 11 straight disciplined wins, over $32,000. Tom is still scraping his crumbs, and Jake, after fighting every single lesson, is down near 15,000. Now the capstone, where every skill in this course stacks into one trade, and we see what each habit is finally worth. Chapter 12. The Trading Plan. Everything in this course was a piece. This is where the pieces become one trade. Step 1. Stack the confluence. You do not take a trade because one thing lines up. You take it because everything does. The structure is bullish, price is at a zone, an indicator agrees, and the stock is a relative strength leader. When the whole chart points the same way, that is an A+ setup. Step 2. Write the bracket first. Before a single cent is at risk, you write down 3 numbers: your entry, your stop, and your target. You decide these when you are calm, not when you are emotional and already in the trade. Step 3. Size by the stop. You risk 1% of your account, no more. And the distance from your entry to your stop tells you exactly how many shares to buy. The math removes the guessing, and the guessing is what blows accounts up. Step 4. Execute and journal. You take only the A+ setups, you let the plan run untouched, and afterward you write it down. Win or lose, you grade the process, not the outcome. Trade the routine, not the mood. Confluence, the bracket, the sizing, the journal. Now watch all 12 skills pay off in one final trade, and watch one trader ignore every one of them. The capstone, every skill in this course on one chart. This is Apple this spring, and watch how the whole language comes together. The structure is a clean uptrend, break of structure, higher highs. Price pulls back to rising support, a zone. The RSI resets to 50 and holds above it. The indicator agrees, and Apple is leading the market. Relative strength confirms the name. Structure, zone, indicator, strength, everything agrees. That is an A+ setup. Jake sees one thing: it has gone up, so it has to drop. And he fires his final YOLO and all in short against the entire chart. No stop, ignoring every lesson he refused to learn. Mike takes the A+ trade, buys the bounce at 298, stop under support at 294, target the next leg at 306, size to risk exactly 1%. And this time, even Tom takes it. He has watched this formula win 11 times, and he finally trusts it, sized up his best trade of the course. Now it settles. Price bounces off support exactly as the plan said. Jake's short goes straight into the green wall, and he blows up. $900 gone, his worst, but he survives. And price tags 306, Mike's target, his biggest win of the entire course, $1,100, because every single skill agreed. That is what the whole course was for, not one indicator, but all of them stacked on the right stock with a stop and a size. Let us see the final scoreboard. 12 chapters ago, 3 traders started with the same $25,000 in the same charts. Here is the final scoreboard. Mike 33,655, 12 disciplined trades, structure first, every one size to 1%, he never chased a price. Tom 26,410, his single best trade came at the very end when he finally trusted the formula. Imagine this curve if he had trusted it from chapter 1. Jakey 14,400, he fought every lesson, shorted strength, traded every cross, fought the line, caught the knife, and YOLO'd the capstone. Down 42% with no checklist, no sizing, and no stops. Same charts, same year, same money. The only difference was the method, and the method is now yours. Before you go, walk the road one more time. You own every step of it now. Act 1, you learn to read structure like an institution. Market structure. A break of structure continues a trend, a change of character reverses it. Order blocks, the candle where the big money bought. Fair value gaps. The imbalance price comes back to fill. and support and resistance, where a broken ceiling becomes a new floor. Act 2, you learned the indicators done right. Moving averages. By the kiss of the rising line. The RSI, the 50 line is your trend filter, not 70 and 30. The MACD, only the cross above the 0 line counts. Anchored VWAP, by the touch of institutional cost. And Fibonacci, by the golden pocket, never the knife. Act 3, you learned the edge. Relative strength, by the leaders, skip the laggards. The pullback versus the retest, time it, do not chase it. And the trading plan, stack the confluence into one A+ trade. That is the entire language of smart money trading. And you just watched, dollar by dollar, what speaking it is worth. Before the goodbye, a final exam, 6 real charts you have never seen. No labels, no hints. Read each one with me. Question 1. This is Roku through the winter. Price climbs off the November low in a clean staircase. Higher highs, then higher lows, step after step. And the latest step sits just above 108. So far, a healthy uptrend. Now look at January. First, the rally stalls under the old spike high from October, a ceiling that never got cleared. Then one red day closes below the latest step, and below the step before it too. That is not a pullback, that is the structure breaking, and the aftermath proves the read. The broken shelf becomes a ceiling. The bounce stalls inches underneath it and rolls over, and the stock waterfalls another 25% before it finds a floor. When the last higher low goes, the uptrend is over. That was chapter 3. Question 2. Datadog in the spring. For 3 straight weeks, every rally dies in the same place, a lid near 118 that rejects price again and again. Then, in early June, a wide candle finally closes above the lid. Here is the exam if that breakout is real. What should the very next pullback do? It should land on the old lid and bounce. Watch. 3 sessions later, the pullback comes and touches the old ceiling almost to the cent and holds. A second dip 2 days later stops a few cents above the lid and holds again. Resistance has become support. The roles have flipped, and the proof from that flipped floor, the stock runs more than 30% within a month. Old ceilings become new floors. That was chapter 4. Question 3. Nvidia is in a powerful uptrend and the RSI just hit 76, deep into overbought. The textbook says sell. Should you? No, in a strong trend, an overbought reading is a sign of strength, not a sell signal. Selling it here is how beginners get run over. You wait for the 50 line. And the chart proves it. Instead of crashing, the RSI resets to about 50 on the next pullback. The dip worth buying. And price runs straight to new highs. Overbought meant strong. That was chapter 6. Question 4, the last one. Price has broken above a ceiling it was stuck under for weeks, and now it has dipped right back down to that same level. Do you chase, dodge, or buy? You buy the retest. When a ceiling breaks and price comes back to it, that old ceiling becomes a new floor, as long as it holds on the close. Chasing the breakout candle is how you buy the top. The retest is the low-risk entry. And here it holds perfectly. Price taps the old ceiling, closes back up off it, and launches to the measured move. A broken ceiling becomes a floor. That was chapter 11, and that completes your exam. And that is the complete Smart Money course. 12 skills, 1 language, and 3 account curves that show exactly what the habits are worth. Your homework before anything else: pick one liquid stock, open its daily chart, and read it top down. What is the higher time frame structure? Where is the zone? And does one indicator agree? 3 answers, then a decision. Do that every day for a month, and you will trade like the institutions you used to fight. Next up, weekly stock playbooks, where we run this exact routine on the names you ask for. Subscribe so you don't miss it, and drop a comment with the chart you want broken down next. See you in the next one.